and I'm your host, Jason Seward, and today's guest is Jason Balin, co-founder of Hard Money Bankers, one of the country's most recognized private lending companies. Since 2007, Jason has helped fund real estate investors while building a business around responsible, relationship-driven lending. Beyond lending, he's personally invested across residential real estate, private notes, office, multifamily, and self-storage, giving him a unique perspective on how capital creates wealth in real estate. Jason is also the author of 3 books, hosts both the Private Lenders podcast and the Real Estate Reserve podcast, and mentors lenders across the country through Hard Money Mastermind, where he helps entrepreneurs build and scale their own private lending businesses. Today, we're stepping back from the mechanics of hard money to talk about private lending as a business, an investment strategy, and how both lenders and borrowers can build long-term success. Jason, welcome to the show, my man.
Jason, thanks so much. I certainly appreciate it. Definitely looking forward to it. It's going to be a lot of fun. That was a good ball out of me. That summed it all up. So,
Yeah, man. I for those, a lot of our audience will know of you, probably have listened to you weekly for years on your podcast, and several will probably have been through your mastermind or some of your training, but a lot have not. So the unique thing, in talking to Jim Ingersoll, who runs the Dealmaker brand and community and everything, I wanted to get, I'm a lender myself, but I don't have the experience. I'm 5 years into it, 3 with the company I have right now. I don't know of very many people that have been lending at your level for as long as you've been lending. So you started this in 2007, is that correct?
Yep, 2007. And I actually had a little bit of experience with private lending before that, but we officially started Hard Money Bankers, my business partner, Chris Haddon, and I, in 2007. So, 19 years ago.
Yeah. So, let's start right there, man. First of all, you guys are based out of Maryland, correct?
Correct.
Yep. And is that where you've been the entire time? Did y'all start in that market or?
Yes. Well, we're very localized, and we believe in localized lending, localized investing. And I know that differs from a lot of other folks, and that's fine. But we're only comfortable in lending in markets that we physically know. My business partner, Chris, and I both grew up in Maryland suburbs, just right outside of Washington, D.C. And, if you know the East Coast, if you know the Mid-Atlantic region, a lot of these markets kind of overlap a lot. So I was actually living in Baltimore when we started this company. I was working in Baltimore, as well when we started this company. So I knew Baltimore and I knew Washington, D.C., and really they're only 40 minutes apart. They're very, very different markets, but they're 40 minutes apart. And a lot of D.C. investors don't want to invest in Baltimore. A lot of Baltimore investors don't want to invest in D.C. area. So it was kind of unique that we actually knew both of those areas and we understood real estate in both of those areas, which was helpful. But yeah, we started here locally, and we would lend all over all over the D.C., Maryland, Virginia area for the first few years and we'll get to this in the story, until we eventually expanded into some other local geographic markets.
Gotcha. So, you guys could have, you obviously knew the real estate game, because you don't jump into lending without having some experience or knowledge of it. And knowing what you knew then, you could have, and it sounds like you have done some of this as a supplement to the lending business, but you could have built your wealth buying rentals, flipping houses, developing apartments, whatever. Why did you guys hone in on lending?
Personally, I don't believe that I'm a great real estate investor, and I think Chris would attest to that as well. We have owned real estate in the past. We probably flipped 5 houses before we started our lending company. And then since our lending company, we flipped some houses as well. Didn't have great success with that either, but let me start with the first 5. So we teamed up with a partner that I went to college with, and he was in the Philadelphia market. So it's Northern Maryland into Delaware into Philadelphia. Those areas overlap a lot. And he was flipping some houses, and he was like, "Hey, would you guys be interested in flipping some houses with me? We can get a hard money loan." Back then, we were getting hard money loans at 15% and 5 points. And what kind of the aha moment that put us over the edge was we'd flip maybe 5 properties in about 18 months. And we did okay on them for the most part. And keep in mind, this was 04, 05, 06, 07, stuff like that, when the real estate market was going up. right? So like you didn't even have to have a good deal and you could still potentially make money. So we kind of just we kind of just skated through with these. And I remember the last deal that we did. The last deal was an absolute headache. It took a lot longer and a lot more money than we expected. And at the end of the game or end of the dough, maybe it was about 10 months, 11 months, 12 months. We, for the most part, broke even. But the person that did not break even was the hard money lender. The guy named Ray out of Texas that lent locally to us that we built a relationship with. And we look on the final settlement statement. We're like, Jesus, we're just kind of breaking even, getting all our money back. But you know what? Ray got that 15% payment from us every month. Ray got those 5 points from us every month. So Ray made whatever it was, 40, 50 grand on that deal. We made zero when it was all came and done. I was like, you know what? I like this lending side. And Chris and myself both do have a lending background. We both worked at a bank early on after college, and we both worked in mortgages, mortgage banking, and mortgage brokerage, subprime stuff, NA paper. So I did understand how not only the real estate transaction works, but also the lending side works. And a lot of lenders, hard money lenders, some of them have real estate backgrounds, some of them have mortgage backgrounds. Most of them don't have both. So we did have a little bit of both, which made it easy and very very relatable to us. But we were actually looking, when Chris and I wanted to start a business, we actually thought it was going to be a regular mortgage company business, mortgage broker business, not necessarily a hard money lending business. And then we kind of had that aha moment with Ray, the lender, and we're like, you know what, this is the business that we want to start. We didn't have any of our own capital. We didn't really know what we were doing, but we're like, hey, let's figure out how we can make this work. And that's kind of the story of the cool part was like having that aha moment of like, this is the type of company that we want to start. Now let's figure out how to do it.
Was there a variable in play that, like, at that time, you're talking 20 years ago, there wasn't a lot of Rays out there. Like, there wasn't a lot of hard money. It wasn't, and we'll get into how popular it has become, but at that time, I had a guest on here a couple weeks ago, and he talked about he ended up going on to start a bank in South America because there was none. And his mindset was, like, people are buying property down here. They don't have an avenue when they live in America to borrow. So he said, I'm going to create it. Don't know how, but I'm going to create it. So his mindset was, let's play a game that there's not much competition. Was that a variable for you guys?
There was not much competition. That is accurate. There was no capital. There was very little capital and liquidity in this space to begin with. So just having capital made us, the best game in town, just because we were able to eventually raise capital to do so. So back then, and I think real estate if someone's been in the real estate investing space for 20 plus years, they probably know this as well. A lot of it were older attorneys that ran title companies, that understood real estate investing, that had clients that were always looking for private capital. It wasn't really hard money. It was private capital. It was just private money that people would have, mostly their own. The companies that started funds, those were bigger companies that were doing bigger commercial assets. They weren't doing like fix and flip loans or small bridge type capital. It was never really a full business for most companies. It was like a side gig where it's like, oh, right, I got $3 million of my own money. I got this client that, flips properties here and there, and, I just lend the money, on the side. So just being able to get capital was big. And we actually, we had a lot of limited beliefs like everybody else, like everybody does in businesses, but and I don't want to pretend that anything was easy because it wasn't. Looking back 20 years ago, it's like, this wasn't too hard, but in real time, it was sleepless nights. But we were always like, well, if we can only, if we just get the capital, we can make this thing work. It was all about capital because, like, we didn't really come from rich families. We were in our 20s, like our mid-20s back then. So, like, I didn't have any capital. I did have, a small HELOC on on a primary that I had back then, but, like, nothing substantial, obviously. And it was funny because we would go and we'd be like, we didn't know anyone directly with capital, but what we learned, and this is something that we also talk about publicly today, even if you don't know anyone with capital, somebody who knows somebody with capital.
Yeah.
Right. So, and that's where all of our capital had raised because it wasn't from one direct person that we knew. Like our first capital investors that we brought on, one of them was a friend of a high school friend's brother. So our friend's brother was about 4 years older than us, and one of his friends had made a good amount of money in internet marketing and stuff like that, and was entrepreneurial, owned some properties and things like that. So he was looking, he had capital. He wasn't looking to get into private lending, but he had capital. And he was opportunistic, right? So like that was one. We were friends with an attorney at a title company, and he was like an investor friendly attorney, and he had a family member that might be interested, that he was like sending deals to his family member. And he's like, well, if you guys have deals, like I can just hook you up with him and he'll do deals with you. Another one was, a referral from from a real estate agent who had a client that he was like, oh yeah, I think he does lending. Let me call him and introduce you. So like that's where a lot of this stuff came from. And from our surprise, the capital was a lot easier to raise than we expected because, and we didn't know this at the time, but it was really because our deals were good. And we didn't know the difference between a good deal and a bad deal back then. Fortunately and luckily, they were good deals. It also helped with timing of the market, right? Because you could buy a property for 100 grand and sell it for 200 grand a few months later. That didn't last forever, obviously, but that kind of did happen early on. But what we realized, and I remember when we were doing like investor presentations, we were meeting with people honestly out of our league, older folks that had capital that we'd met with. And well, this happened almost every time. We have a conversation with them. We're very ambitious and excited. We're like, hey, so the buyers that we're working with, they have good credit. They have down payment. They have experience. They have good assets in these particular areas. They're paying a 15% interest rate with return because that's what the rate was then. And either we'll take 3% to service the loan, we'll do everything on your behalf. You'll get a 12% rate type of thing. And they're like, well, if what you're telling me is true, like, sure, I'm happy to do that. You're telling me like these borrowers have good credit, these borrowers have experience, these borrowers, have this asset. They're able to buy it at under market value. I'll be the first lender on the property, least amount of risk. Like, that sounds great. Like, bring me deals and I'm in type of situation. And then the hard part actually happened was it was like, great, we know all these borrowers. We've been in the mortgage industry. We invested in some real estate. All these people, that we know, they're all looking for capital. And then it was actually a lot harder to find good capital or good borrowers at scale, right? You can find someone here and there. Because the challenging part of this business is anybody can do this at a small scale. Hey, I know a few people that need some capital, but like that's just the lowest hanging fruit. Everyone knows a few people. But after you get out of the few people, it's a lot hard.
Right.
It's a lot harder to do. So that's typically what happened, and kind of just like married the deals together. It's like, oh, this borrower needs money. This capital investor has some money. We'll middleman this thing together. A lot of our lenders were actually doing this already, and were sophisticated enough to understand this. And they were lending out, but they were like, oh, you'll do all the work for me. You can find the deals. You can do the headaches. If the property goes into foreclosure, you'll handle all that. I'm happy to just invest money with you guys and have you do all the heavy lifting.
Yeah. Yeah. And I think I want to encourage folks, and we'll drop all your links in the notes so they can check it out. But to go, like, you guys break this down on a weekly basis in very, very detailed fashion. So like every nuance of what you're doing, how you're doing it, how you're structuring. So you and I could spend 3 hours going through all that. I don't want to do that today, but I do want to ask you this. There, for those that aren't familiar, there's a couple different avenues for short-term lending. You can do it you guys do a co-lending model, correct?
Yep.
Then there's funds. We do it as a fund. You could be a broker. There's several different models under that. Um, Describe basically at a high level how you guys structure this when it comes to tying investor capital into the deal, into your business, and then why you guys have chosen to start that way, continue that way.
Yeah, keep in mind, no matter which way you do it, you can still do this through like security wrappers. So even if it's a co-lending fund or even if it's unsecured money to you personally and then you lend it out, because people do that as well. Hey, an investor has $1 million. They give it to that company. They promise them a 10% note on that money, and then you'll go lend it out, and they're not tied to the deal. But you can still put securities wrappers and do SEC filings on all of these particular things as well, if that's something that's concerning for someone of like, hey, I heard I can't necessarily do that. Like definitely talk to your securities attorney because there's ways to potentially structure it and not just the fund model. So there's a few different co-lending types of models. Sometimes they put the lender on the note, sometimes they are on the mortgage, sometimes they don't. the way that we do it, in essence, it's a co-lending agreement that we have in place, and we're in essence closing the loan under our name and then assigning them. We're assigning the entire loan package to the lender for the capital. So if it's a $100,000 loan, they're investing $100,000, or I shouldn't even say investing because that's not actually the right word. They're actually lending $100,000, and we're co-lending with them. Now, some of our loans, we might be co-lending 50-50, right? We put up half, they put up half. Some we might be putting zero, and they might be putting all of it in. It just depends on, the type of situation. And then we do a co-lending agreement, which is a one-time Lincoln agreement, and then we do an assignment agreement. And in essence, they are the legal lender on paper, and then we're the servicer, and we retain servicing on that. A lot of people think that's absolutely crazy. Like, you got so many investors involved in all these different, in all these deals, and there's a lot of moving pieces. The fund would be way easier. They might be right. It's just what we're used to. It's what we've done for 20 years. So it's it's somewhat simple for us, just because we have it set up. Again, because they're the lender and the borrower doesn't pay, like, well, I'm not on the hook to make them, that monthly payment every month,
Right.
on the defaulted loan. So, and in essence, they get the good and the bad. If the loan goes into default, they get they get an elevated interest rate. If the loan, whatever goes sideways, again, it's not on paper. Yes, they're the lender, but in reality, we step in and we run everything as the co-lender on that.
Yeah.
Bad business if there's going to be a bad deal. And I'm like, oh, here you go. This is your problem now. I mean, we've been in business for a long period of time. I've obviously had my fair share of defaults and foreclosures, REO and things like that. And again, we keep this as an easy investment for our capital partners. So, but again, you could structure it any way you want. You can create, again, securities wrappers and SEC filings for a co-lending agreement. Even with the unsecured stuff. I mean, we know a lender in our group. And the reason I'm saying this is because there's lots of different ways. So I don't want the barrier to entry to be like, somebody be like, oh, I can't get into this because I don't want to do a fund. I don't want to spend $20,000.
Which is exactly why I asked you this, to kind of illustrate that there's so many ways to skin the cat.
You got to do ways to do it. I mean, we know a lender that's like, hey, I only do things as unsecured notes to my company because they're all, good relationships that I have with these capital investors. They trust me exclusively. They just lend me the money. I can do whatever I want with it for the most part. And then this particular lender got an SEC attorney to file, to do a securities filing, in order to legalize and map the way that he's structuring it. So
Right.
you could do it, how do you want. And again, the stuff that we're talking about is all private capital. There's a whole different world of institutional backed capital that I can't claim to be the expert at, because I've never taken on institutional capital in 20 years, even though it's been jammed down my throat daily.
Yeah. Right. And I think the bigger point there is, like, if your barrier to entry, again, is just being intimidated by, oh, I don't know what that means, or I don't know how to do this. You guys just started that way. It's the way you learned to do it. It's the way you were comfortable doing it. We knew we wanted to be lenders and start a company around that. We just happened to land with a mentor that did it as a debt structure, and we just aligned with them, and it made sense. I built it that way. If in another life we could have landed with you guys and been doing the exact same, so it's just wherever you land. But I think a key takeaway there is, and we're going to get into it in a little bit, but how important it is to not just dive in without having you need to have some type of coaching, mentorship to, at worst, get your documents set up correctly, know how to underwrite, stuff like that. So, and with that, I'm going to segue into kind of my next thought is, we mentioned it earlier, back when you guys started, there wasn't many people doing it. It was like, you guys, if you structured it and you could get capital, you were unique in the real estate space, offering that capital. That has changed a lot in the last 20 years. There are lenders, even within the last 5-10 years, there are lenders literally on every corner. On every social media post, you're going to see 30 comments of, I can help you, I can lend. And it's a wide variety of folks doing it like y'all, private capital, literally lending their own money, or brokers, a lot of brokers out there. brokering for institutional capital. But my point is, or I guess my question to you is, why, in your opinion, has it become so attractive so fast in the last 5, 10 years?
Well, I think because Wall Street decided to invest in this asset class and they were able to put billions and billions of dollars behind it in capital, and it inflated a lot the investment markets. I mean, I think they saw the need for it, and like, I don't believe it's going to be there forever. And I'm surprised it's still here. I actually thought March 2020 was the judgment day for institutional capital sources during COVID, and I thought they're all going to dry up. And it did dry up for 30 days. And it was the best loans that I've ever done in 20 years was March 2020. When no institutional capital was funding loans. They weren't releasing draw requests. They're on a hold and waiting pattern. And I'd had the best of the best of the best borrowers reach out to me. Be like, "Harry, I got to do this deal." And like, we cherry picked such good deals then. I mean, I was still scared. And I was still, man.
You know what? We were buying and holding a lot during that year, and it was the best deals we've ever done because there wasn't a lot of capital we were using our own cash at the time. So we could go in and buy a deal. We didn't have to rely on the dried up capital that everybody else was. So yeah, that was a good little spell there.
The problem, not a problem. The thing with the real estate, just like with lending, just like regular real estate investments, you only know what you know, right? You go based off your past experiences, off what you do. I mean, listen, there was 2,600 people in our online mastermind group. Every single one of them thinks they do good deals, good real estate deals. They just do, and that's fine. And I'm not going to be here to tell them that they're not. You're going to learn of what's a good deal and what's not a good deal. I consider ourselves to be very conservative. We have borrowers that put a lot of cash into deals. We also, because we're very conservative, and I learned this years ago from, I know Alex Hormozy talks about this in a lot of his podcasts, but when I was in Russell Brunson's podcast, or Russell Brunson from ClickFunnels Mastermind about 10 years ago, he was like, "Listen, you guys either need to be the most expensive or the cheapest in the room. You can't be both. The people in the middle kind of go and die. You got to be kind of like a commodity and be the cheapest lender. You got to be the most expensive lender." And he didn't exactly say it like this, but he was saying that for, in his industry. And like, we've been the most expensive. We've been the most expensive lender. We've been the, lowest leverage. I know what defaults look like because I've been through lots of them. And even if you wrote a really good loan at a really low LTV, they still default. I'm dealing with a deal right now that's been defaulting. The borrower ended up being a lot less sophisticated than I thought they were going to be. They couldn't make grown-up adult decisions. They had a $200,000 property. No, we have a $200,000 loan on a $1 million property that has been literally in default for 3 years. Maybe even 4 years at this point. The loan defaulted. We went to file foreclosure. They filed bankruptcy. That stopped the process. Then we realized there was a total defect when we got all the way almost to the foreclosure date. We got it out of bankruptcy. They filed bankruptcy again. They filed bankruptcy. I mean, I got endless stories about this. Finally, we got this thing almost to foreclosure, and we're like, wait a second. Like, there's a total defect. So instead of like title insurance just paying out, because title insurance don't want to just pay out, it's like, cool, well, as a title claim, we're going to get you into first position again to insure your first position. Then you can foreclose. Anyways, 4 years later, default rate of 24%, no payments being made. You can do the math. We had to step in once to pay a defaulted, blighted tax bill that was elevated because it was because the property was in disarray. It ended up being $70,000. We had to pay insurance multiple times. Just imagine what our payoff actually is. When it's all said and done, it's probably going to be a pretty good payoff as long as it doesn't get negotiated down too low just to exit it. But like, it's 4 years of no capital coming in. It's 4 years of headaches. It's 4 years of throwing good money, to keep this thing moving forward. Listen, you have a deal like this here and there. It's not the end of the world. But imagine if that's your portfolio over and over and over. You're just playing defense all day long. So good deals still default. Would I rewrite that loan again? Probably. But like, point is I tell our business partners this all the time on, questionable deals. This deal will work out. It will, but it's going to be a headache. And how many headaches do we want at any given time? The right lenders want to write good loans to good borrowers. They're going to perform. They're going to pay off so they can recycle their capital and do it the right way. That's what we've learned has been the best business model. When we sold in this space, there's a lot of loan-to-own lenders, which aren't really, I'm not saying they're not around now, but at scale, there's not many of them around there. But the goal is to like good loans to good borrowers. They're going to pay and just, keep it moving because crap happens. Like good borrowers, everyone comes to an end. At some point, a good real estate investor is going to make a mistake somewhere along the line. And if you're enabling them by getting an institutional capital enabling them, by getting them high leverage and cheap terms and no skin in the deal, they got no vested interest. When that time comes that market shakes up a little bit, and all of a sudden it's like, oh, we thought the ALV was 300, now it's only 180. Yep. Oh, not it's 400, now it's 280. Sorry, it's not gonna be that extreme.
Trail of the gap.
Yeah, 300, now it's only 290 or 280, and that was my margin. I got nothing to lose because I didn't put any money into it. I'm gonna walk away from this thing, and you're stuck holding the bag. And nobody wants to be stuck on a property where the borrower is not cooperating because it is a freaking headache.
Yeah, yeah, and I think it's a lot of, I mean, you're talking about having skin in the game. A lot, we get a lot of pushback because we don't ask. You guys get way more skin in the game than we do, but we still get a lot of pushback. And we stand firm in that just because of what you just said. If somebody has 10, 20, 30% into the deal of their own hard-earned money, they're going to fight harder to save that deal next to the other deal they have down the road that somebody let them get in 100%, no skin in the game. They're going to let that one go before they're going to let mine. They're going to fight harder for mine. So that's just, and for us, and kind of talking to people that want to lend, because we get asked a lot, what's the thing? Well, you got to know how to underwrite a deal. You've got to be prepared to at least visualize the worst case scenario, which can be pretty bad, and how you're going to get through it. And that, I think, and my next question to you is like, what in this business is harder? Because you coach so many people and you have the mastermind going and so many people coming in and going out. What's harder than people expect that you've noticed?
I mean, it's a lot of lenders, chase, they're chasing deal flow irresponsibly, and they're doing too high leverage, and they're not charging enough for them. And at the end of the game, at the end of the day, it's like, look back, it's like, you didn't make that much money compared to this. This is an investment. Like if you want to treat a hard money lending company like a mortgage company, don't take any risk and just go, chase institutional back capital and let them take the risk and break our loans to them or be a correspondent lender. I don't want to be in that space. This is a for-profit business, and this is an investment vehicle, and we're not doing deals just to do them. We're at a 13% in 3-point, 13% rate in 3 points. And, we started at 15 and 5 for the first, 5 or 6 years, went to 14 and 4. Over a decade ago, went to 13 and 3. Like, I'm not going any cheaper than that. It doesn't make sense for us to do that. I almost know this for a fact that if we wanted to, and we have about a $50 million portfolio that's been outstanding, and we've had that same outstanding portfolio for probably about 8 years. We've stayed about the same size-wise. Not profitability. We've been able to become more profitable with other income streams through it. But anyways, we could probably get to 75, 80 million. We have enough capital to do so, and we have, enough lead flow to do so. We could probably grow to $25, $30 million more within a year if we wanted to lend out at less rates. So instead of 13 and 3, probably 12 and 2, 11 and 2, I don't know, something like that. And, be higher LTVs and go 10% higher on our LTVs and require smaller down payments. Net effect is not going to make us more profitable. I don't know that for a fact, but I just don't see that being this solution. I just don't think that's going to be that more profitable.
Yeah, and when you're talking about that level of capital, and we're kind of getting there, we're at about 25 million, and it's like, okay, do we want to compromise our returns at all just to bring more capital in? And at the end of the day, if we go from 25 to 35, the net income might end up being exactly the same. So why would we do that? It does not make sense. So with the lever you guys have pulled, which I think is great, instead of doing that, you just ramp up marketing and you just go all in on marketing. And you guys, again, this could be another episode, but you guys go hard with marketing and you test things out and you track the data and you go where that leads you,
keep my money out. And here's another interesting thing. Lenders are notoriously bad at spending money and not wanting to market. Like think about big fix and flip companies, wholesale companies. Like they're spending a lot of money on PPC, direct mail, whatever they're doing, TV advertisements. But then a lot of these lenders are getting into or a lot of these people, investors are getting in the lending business, and they don't want to spend like a few $1,000s a month. Like for some reason, I don't get it. Like they don't like anyone that running big operations or either doing a ton of sweat equity, right? Like wholesalers, and I don't know if this is a game anymore, but back in the day when wholesalers were just massively going to auctions and buying up everything, and then doing substitute purchase agreements or grossing them up and then selling them to other. But anyways, they're doing sweat equity to go to spend the time on that, or a lot of the big wholesalers and a lot of big flippers locally, at least in our market, they're doing TV advertisements. I'm getting direct mail from them. They're doing a lot of things. They're spending lots and lots of money. Then they're getting the lending business, and they have this assumption that it's like, oh, well, I have the money. I've got the capital, so like, this should be easy. This should just be a passive investment. The borrowers are just there. And it's like, you're right. There's going to be plenty of borrowers knocking down your door. You go raise your hand at a group or meetup group where you tell people you're lending. There's endless borrowers that will accept 100% financing and terms, like Kiavi. If you want to match institutional, and I know Kiavi is not technically Kiavi anymore because they sold a few weeks ago, but anyways, if you want to match the terms of an institutional capital lender, you can by far have plenty of deal flow.
Yeah.
But it's going to be risky and it's not going to be profitable. And I'm not going to say a name on this. I don't know if you know who this person is anyways, or the name of the company, but Chris and I were doing some consulting recently with a lender, and we kind of had a disagreement on the types of deals that he should do. And he was like, listen, he's like, I've worked for this institutional capital source for 8 years, and they're very successful. I'm going to raise my fund over here. I'm going to go raise private capital from my fund, and I'm going to match their model, which is a 95% LTC model, loan to cost model. So the borrowers have to put down 5%, and I'll do everything else. And I don't know, however the structure was, and it's going to be cheap, 10 and 1, 10 and 2. And in his mind, he was like, well, this company's had a lot of success for almost a decade now. I'm going to just match exactly my model, my lending model to them. And I'm like, well, first off, you only see the good side of that business, right? You won't know what the economics are on the back end. And number one, they're probably getting cheaper capital than you are through your fund.
Right.
But we also don't know what their back end looks like. You just know what their front-facing stuff looks like. Everybody front-facing is successful. So I'm like, you got to be careful because a lot of lenders don't want to do the heavy lifting. They don't want to do the marketing. And I'll tell you, it's a lot of work because I got 5 full-time people between business partners that run our other markets and loan officers. And 99% of their day is on the phone running deals. That's their whole job, is finding deals. Either cold calling, one of them likes to cold call off lists. Like that's just what he likes doing, and he likes converting that way. One of them likes to go to tons of meetup groups and rear groups on a regular basis because he's a good networker, and he does that. Obviously it's following up with our databases and our past clients, and we run everything through. We use GoHall Levels, our CRM, and we were very active sales campaign of automated stuff, manual stuff, follow-up stuff, in-person stuff. Like we're just doing a lot of stuff. So I certainly understand that like most people don't want to do that. And I get that. But in order to kind of maintain, the most leads, the highest quality leads over and over and over, because let's be honest, if I have 100 leads today and another lender has 5 leads today, at the end of the week, we each have to close a few deals. Like I believe my deals are going to be better. I just have more to choose from. And so but again, it just depends. I mean, there's a lender that I know that has access to very, very cheap capital. They won't want to spend the marketing side of it because they think it's a lot of hard work. So they're like, hey, I'm just going to discount my terms and just lend out less. And net, that might be better than me spending, $100,000 a year on a loan officer commission or $100,000 a year in Google AdWords or whatever that case is. So there's a million different ways to run this business. I've seen a lot of different things. I'm sure you have with a lot of the other lenders that you know as well.
Yeah.
It's just match whatever model works best for you. I mean, we're just conservative by nature. I mean, I can tell you that like Chris and I have never hit like a home run in any real estate investment deal, but I hit singles literally every day.
Right. Yeah, and that wins ball games. I think a lot of folks. I mean, I came from my background was in the insurance industry, sales, and like so I knew the mechanics of the insurance company, the financials, all that stuff, and it is a strategy in that niche where you kind of buy into a market, right? So you see what the State Farms and the Allstates are doing, so you kind of undercut rate with the plan to slowly raise it over time. That model does not work here. That does not work here. Like if you set a precedent that I'm the cheapest guy on the block and I'm gonna give you 100% financing, at some point, that's either if you stay there, you're gonna get in trouble. It is not sustainable. And if you decide to unwind that and raise your rates to dial it, like you're gonna lose your clientele. Like it's not gonna work. So, but we see, especially in our markets, just I mean, we occasionally lose borrowers that find somebody that's doing 10 and 2 and they're deferring interest to the back end and they're giving them 100% financing. And like, yeah, I would take that too, but that lender is not going to be there very long. There's no way.
And all these lenders have, you know, been there a lot longer than I would have expected.
Hi, yeah. Yeah.
Well, like here's the one thing that I've said that I think, and I don't know if this is right or not. But I do believe that there just hasn't been that many massive realized losses in this space yet. That doesn't mean that there's massive defaults, but like think about this. So let's say like half of my portfolio is in default. That doesn't mean like I'm going out of business or I'm bankrupt right now because they're not realized defaults.
Yeah.
Like they're not like I haven't been to a point yet where it's like, hey, I have to file bankruptcy. Everybody's suing me. I'm walking away. So like front facing, you don't know that. You don't know how a company is doing until it's kind of too late. And what we've always talked about with Kiavi is I felt like Kiavi would either go bankrupt or have to sell. They're a growth company. They're right. Like it's not like, oh, hey, we've got this great little cash flow machine that's going to stick around forever. Hard money bankers for us is a long-term wealth vehicle cash flow machine. I mean, most lenders 20 years ago, they got into this space to make cash flow money and to make money for their retirement accounts, right? They would do self-directed lending and they do cash flow. Nobody was talking about selling companies like these big
Right.
these companies. They're not talking about selling, and they're not even talking about massive scaling. They talk about, hey, I need a place to deploy my own personal capital. Chris and I didn't have any personal capital when we started this. The other law, and I didn't even know this was a wealth vehicle when I started this either, because it took me till year 3 when our biggest capital investor got a 1099 INT from us for $400,000, and he only had like a few $1,000,000 invested through us at that point, and he never looked at any of the properties. He, knew what deals he was in, but he didn't do anything. And I'm like, God dang it! And Sir Chris, I was like, this dude made $400,000 off all of our hard work. We didn't make nearly that this year. This is year 2 or 3 or whatever. And I'm like, that's where it's at. We need to be taking all of our excess capital and we need to redeploy it into our own deals. Because again, in this business, there's a passive side and there's an active side. And a big mistake, a lot of capital investors people that have capital, they get into this business because they're like, oh man, this is an easy business. It's passive. I can get 13 and 3, 14 and 4, 10 and 2, whatever. I can make 20% annualized. You can make 20% annualized if you're doing the heavy lifting. If you're not doing the heavy lifting, the going rate's probably about 10%. So like, I have both sides of it. So yeah, I can make, my 10+% of my own personal capital by deploying into deals in our company. And I can also make that extra 10% actively by doing the hard work. You can't have both unless you're doing it.
Two of our biggest investors in our fund were private lenders of their own money for several years. And, they were making the, 15 to 20% returns, but at the same time, they were dealing with all the headaches of the and they finally threw their hands up and said, we're going to dump it with y'all, pay us what you pay us, 10, 11%, and y'all go do your thing. We don't have to think about it. And to that point is like, this is not a passive business if you're going to operate it. Now, if you want to invest with somebody like Jason, it can be passive. Your returns are not going to be as good, But if you want to be a lender and be the ones holding the reins of the whole process, the underwriting all the way to payoff, it is nothing passive about it. Nothing, right?
No, not at all.
Okay.
Not at all. Not at all. But people think that, people want to do passive work and get active returns, and it doesn't work. Doesn't work like that. It's one or the other.
So we'll start kind of wrapping things up, and I want to talk about specifically what you guys are doing. So first, you've kind of talked about the lending side of it, and where you guys started in Maryland. But where else are you guys offering lending at this point? I know y'all have expanded quite a bit.
Anywhere from like Raleigh, North Carolina, up through northern New Jersey for the most part. So we started DC, Maryland, Virginia. A buddy of mine, one of my college friends, business partners, was doing a bunch of flipping and wholesaling owned a property management company in like the Philadelphia, New Jersey market. That's really only like 2 hours from here, 2 hours and 30 minutes from here. And maybe 12 years ago, we convinced him to come over and do lending with us. So we are like, this is naturally a good market to expand to. So then we did Delaware, New Jersey, and Pennsylvania. And then his brother came on board, and he was in the North Carolina market. So we're like, okay, we could potentially expand there. For growth, for our size operation, and I think a lot of lenders can attest to this, like the way to grow after you kind of reach, and again, it's not capacity. There's plenty of volume. I mean, keep in mind, like companies like Kiavi only had like 6% market share of like, and they're by far the biggest. So there's plenty of opportunities and plenty of deals. I mean, all of us are only trying to chase, anywhere between, 5 and 25 deals a month. Call it 50. Do you remember?
Yeah, Kelly Garrett told me when she was kind of mentoring us, still is, but she told me early on, I asked her, I said, why are you helping build a company that's going to compete with you? I just couldn't make sense. And she said, there's plenty of sunshine for us all. I mean, that was her response. And I'd love
it. Look, there's a lot of deals out there for everybody. And honestly, like, I'm not competing. Like, Austin, an institutional lender, is apples and oranges. It's a different product. Yeah. If we overlapped, because I know you guys do some parts of Virginia and North Carolina as well, if we overlapped and we lost a deal or vice versa, it's because that other lender has a better relationship with the borrower than we do. So we screwed up, right? So I don't really care. There's plenty to go around. And guess what? There's probably an opportunity that someone can refer a deal back and forth. Absolutely. Or someone doesn't have capital and needs different capital in this particular deal. There's more, I don't know, there's more allies, there's more synergies. I mean, we know every lender in our local market, or especially our really local markets that we started in. And it's like, we're not all competing with the same things. And sometimes you think that way when you have a bad month, but like there's plenty of opportunities. So in order to grow, it's really, you got to have salespeople, or you got to have different territories to expand into. And one thing I want to note, because I think this is a misconception, I think everybody thinks when they jump into the hard money lending or private lending, they're only lending to fix and flip investors. And I know that's kind of like the big, the big well-known one, but there's a lot of other ways to be opportunistic to do stuff, right? You can do commercial loans, small balance commercial loans. And if you don't understand commercial, do it slowly. Don't just jump in. It's different. It's a different business model, slightly, not different business models, a different asset class that you kind of understand. You need to understand, but there's a humongous need for small balance commercial. Like, go try to go, let's say you own a building with, I don't know, $1 million or $2 million, and you're trying to get a loan of $200,000 against that building, and it's not fully rented out, or maybe it's vacant. You're not getting a bank loan on that thing. It is hard as hell to get a bank loan on that thing. Yeah, they're also going to charge that operator, $10,000 to do lots of high-level due diligence that they probably don't fully need in order to do so. So, we do due diligence on commercial properties for $1,500 or $1,800, right? So someone that wants a $200,000 loan, to fix whatever, an HVAC system, or maybe to front load tenant TI costs on an office at like a 20 LTV deal. Like, we'll do up to 40, 50 LTV on commercial stuff. The point is there's a lot of those opportunities, lendless opportunities out there. There's also a lot of real estate investors, or they might not even consider themselves a real estate investor just because they own a few rental properties, that are just looking to, get cash out of a free and clear rental property. There's tons and tons of those deals out there. And so many people just don't realize it. They think they're only competing with on fix and flip, and they're trying to get the highest quality fix and flip investor. We actually don't even go after those borrowers because I know they can get 100% financing in 10 and 1 from somebody else. So I'm not competing with that. Like one of our marketing strategies is, we buy data from SFR Analytics, and who actually just merged with the mortgage office, which was interesting. Curious to see how that works, or got purchased by a servicing software. Anyways, we in essence buy data from them, and we'll direct mail them. Sometimes we'll call them. We'll whatever it is. Point being is if you segment that data locally, we have about 6,000 transactions that were done over the last year, right? So a lot of these investors, there's a ton of them that it's like their first deal or a one-off. And then there's, if you look at the top ones, like, oh, they did 120 deals under this entity, or 60 deals or 50 deals or 40 deals. All the ones and all the 30s, I'm out. I don't need to go after them. I want to go after the real estate investors that do like 3, 4, 5, 6 deals a year. That's my target audience personally. I can provide, local service for them, very quick, very simple, personalized. The ones that are doing 100 deals a year, like, honestly, their business can't support paying 13 and 3. Like, they're new 10 and 1, and they're so, so cash constrained because they just have so much money going into all their businesses. They're not going to put down 20 or 30% with me either. So I know who my target demo is, and that's who I go. And most of our real estate investors are good flippers. They, whatever the term is, like, they outgrow our product anyways. I'll do a few deals with them and they're going somewhere else. But I will tell you that we have a lot of loans on our books that are small balance commercial, or just borrowers that own free and clear rental properties. And, maybe they have a turnover and they need cash on that, or maybe they're buying another property and they don't want to go to their bank, or maybe they need a down payment for their bank for the next month deal, right? And the loan property worth $200,000, they need $70,000 because that's their down payment for another building that they're purchasing. They need down payment money, or whatever the case is. So don't sleep on those types of opportunities, because there's endless ones of those as well.
Well, the point you just made, and this is going to be kind of our segue into the last thing, but is perfect, because we were at your mastermind in Charlotte a couple months ago, and that was one of our biggest takeaways, is focusing on those small balance commercial loans, and we've ramped that up. It's been great. Obviously a lot of those loans since that time are still in service, right? So they haven't reached payoff, but the point I'm making there is we had kind of settled into a good flow with how we were doing things, mostly fix and flip. That was 85% of what we had done up to that point. But we go to your mastermind, and I want to talk about your mastermind. And I know you got various levels of it and different meetings throughout the year. But we have been a part of a bunch of networking groups. I run one locally, the Dealmaker group here in Hampton Roads. We got a meeting tonight. But that particular mastermind, the way you guys structure it, and it's just focused on lending, and you give every company that's there an opportunity to go through what's working, what's not, tips, tricks. We all talk about, for a couple days, we're in rooms, we go out to dinner, have drinks, whatever. But it is definitely the biggest impact that we've gotten from a mastermind group was those few days we spent with y'all in Charlotte. So
Appreciate that.
Having said that, talk about what you guys offer and where they can learn more about it if they're interested in taking their lending knowledge to the next level.
Yes, I mean, we never had an intention to start a mastermind group for our money lenders, even though it never existed. But there is a lender out of Richmond that reached out to us maybe about 10 years ago and was like, "Hey, listen, I've been loaning out my own money, decent amount of money for a long period of time, and I feel like I don't fully know what I'm doing. Well, I see you guys online, you guys are marketing for borrowers, well, could you help me out?" And we're like, "Yeah, not really something that we're set up to do, but I appreciate it." It's like, name your price. Well, and I'll come up to you for 2 days. And of course, we were like, okay. So we made the price that was way too low. But we found out. But anyways, so we kind of, like, Chris and I built out a little curriculum to help them out. And then we started just kind of doing videos, because, like, the joke that we have around our office is we're going to talk about lending anyways, so we might as well just put a camera on us.
Yeah.
Well, Mike on us and talk about it. So we just started the Untitled Podcast, which is Private Lenders Podcast, and we've done hundreds and hundreds of episodes that we try to keep them between like 10 minutes to 20 minutes. Ideally, we try to keep them in less than that, just as like one key point related to it. So we did that, and then we built out a mastermind group. We're about 2,600 members in the online group, and we do one real in-depth coaching call every month. That's the Move It. Plus, we've got 7 years of recording loans as well, and then pretty much anything that we have going on inside our business, docs, forms, contracts, things like that. Let's just upload them into the members area so everyone has access to them. And then we've been doing, we've done some private consulting. We've done some private consulting with, I don't know, 100 plus lenders from across the country. And then we have the mastermind group as well. And there's 2 groups. And the tricky part with the mastermind group is we really can't get more than 30 people in that room. Not because the room's not big enough. It's just, you got to have enough time for everybody to discuss and stay on track. And, we do what you discussed, like we do the brag ass share. So you brag a little bit about your company so everybody knows what your current setup is. Ask questions that are relevant at that point inside your business, and then share, something that's really worked for everybody. And, it's what we felt that was kind of the best format, by the end of, and really, it's only 2 full days, because nobody wants to go longer than that. You would. Challenging part for us to help, like when we're doing mentoring and consulting and stuff like that, is everybody's at a very different spot in their business. And if you're not at that point in your business yet, I hate to say it, but it's kind of just not relevant. Like, if you never had a default, I mean, listen, I can talk to you for 8 hours about defaults. I can give you every horror story, every scenario. This is what's going to happen. This is what's going to happen. But like, if you don't have a default right now, you don't care. You just don't.
Right.
So it's one of those things that it gets challenging because every single person has time-specific stuff that they're really, really, like, the main things are, I'm trying to get more deals, more leads to close. I'm trying to raise more capital. And there's a few different kind of operational system stuff that I could use some help with.
Yep.
Like, so everything kind of falls under that, but that's always been the biggest challenge for us, because it's what's important for you, for Jason right now, is going to be different than, Bob. And that doesn't mean that Bob's not going to need the stuff that Jason needs, but he just doesn't need it today, and he's only focused on what he needs today.
Yeah. And then I love the way, for those that are interested, I can speak, like, this is my testimony to you guys, but we didn't just apply and you guys said, okay, yeah, come to Charlotte. Like, I had to kind of go through a screening process with Dave, and then I hopped on the phone with you and Chris, I believe, and we talked for an hour and a half, and then we had to wait a few days before y'all said, yeah, we think y'all are a good fit. Let's go. And so that screening keeps a really tight, good room. And I love how y'all did that. So.
Well, no, I appreciate that. No, because that's important. Because, like, first off, if Chris and I ever did consulting or mastermind, like, we told each other this up front, we're not doing coaching. I'm not holding people accountable. We're going to give the info that we've used, and our way is not the only way, right? Like, if this particular lender that we were talking about wants to do 95% LTC and match up to another institutional, he do it his way. I'm going to tell you the way that we believe is the best, and the way that's worked best for us over the years. And we want to make sure that, the room, it's the right fit. We just did another group that has been our 3rd event for this, and I say newer group, but it's just a different group, because that average group has probably 3 million. Maybe the biggest lender in that group had 18 million, but it was a lot of like 7.5 to $10 million people. Like, yeah. You need different things. Most of them don't have employees already, right? Most of them don't have funds already, because they're doing, one-off direct placement stuff. They're all ready to get kind of into a fund. Some of them have servicing software. Some of them don't have servicing software. So what, you're talking about Kelly Garrett, what Rehab Wallet has to offer, like, they're at a different level in their business than, a guy who has $4 million and he's a one-man band, or 5 million. It just is. That being said, like, this isn't degrading anyone who has a small portfolio. The most profitable and in my opinion, the most successful person that I know is a smaller lender that has like 10 million of his own personal money deployed and is extremely profitable.
Yeah.
N-
His cost of capital is nothing.
Cost of capital is nothing. He has a good lifestyle. He has a lot of the same repeat bars. He makes good money on these deals. He doesn't have employees to account for. If, God forbid, a deal goes bad, he doesn't have to explain it to a capital investor.
Yep.
Like, that's it. I mean, that's my interpretation. Somebody else might be like, well, I want to have, a fund of 300 million and I want to have these employees and I can, that's on them. I'm just telling you, like, so so the purpose is different groups and different types of programs. It just depends on where somebody is inside. And I know that, a lot of the folks in the group with smaller portfolios, like, I feel like sometimes they're like, it'd be nice if I was in some of this bigger stuff. And I'm like, the stuff we talked about in Charlotte was very different than the stuff that we talked about in June.
Yeah, sure. Yep. And I mean, again, I love the way y'all have structured it. I think, I mean, we hear it all the time, oh, you guys are awesome. Y'all have made it to the top level of real estate investing. No, we just found something that worked for us and we're trying to build it and we continue to try to dial it in. But we've been very intentional with it and we've made sure to learn the right way and from the right people. And everybody says, oh, I want to be the bank. Well, that's not, as we've said 100 times, it's not passive. And I want to encourage everybody I mean, you've got your free resources through the podcast. You could go and batch and listen to all of y'all's history of podcasts and know every single thing you need to know to get going in this business. And then have the ongoing mentorship through other things. At worst, I want people to encourage people to do that. I really wanted to introduce you to the Dealmaker audience because I know a lot of folks in your mastermind are attached to it, but there's a lot of folks in this audience that, probably have been curious, but just didn't know what avenue to go to connect with you guys. And I want to drop the links and everything to make that connection if they're interested.
Yeah, I appreciate that. I mean, we're very passionate about private lending. Well, we have been for a long period of time. It's a business that kind of finally hit of like, this is our calling. This is the right business for us. I do feel like we're very conservative on stuff in general. So again, you can you can structure these things however you want, right? Like, there's no right or wrong. And I encourage people that are nervous, that are lending too high. There's some of the lenders that I've talked to over the years. They're like, yeah, I don't know if this is the right business for me. I don't know if it's the right business because, I lost some money. I'm like, you gave the borrower 100% financing.
Oh.
Like, you're doing bad deals. Real quick story, because I know you're trying to wrap this up, but I think this is kind of relevant as well. During COVID, when March 2020, we were talking earlier, a buddy of ours who invests in some of our notes, and he's a good friend of ours as well. Over the years, we've become good friends with him. He was like, hey, man, like, I don't know. I'm scared. I don't know what to do currently. Like, I think I'm on hold. Like, I don't think I'm going to lend anymore. And I was like, why? And I was like, you just stopping investing as a whole? And he's like, no, I'm going to continue to invest in other stuff, but like, just lending, I'm unsure about. I'm like, let me ask you a question. Let's say a borrower bought a property has it under contract for $500,000. Really good deal, a property we are comfortable with. And they said, hey, I'll put up $250,000 if you put up $250. You can have a first note, and I'll put up $250,000 mortgage. And you just give me a first of $250. I'll put up $250. I was like, would you do that deal? He's like, of course I would do that deal. It's a home run. Why wouldn't I? I was like, then you're not out of the game.
Right.
Change your criteria to what you're comfortable with. Like, somebody, did you ever, John, you remember John Paul? You know who John Paul is?
John and I work for the same company. So
That's right. Yeah. So Paul told me about myself. He goes, I've met a lot of people in my past when I was a financial advisor that just didn't have the risk tolerance to do some of these things. And you feel it in your gut when the numbers work. And if you're sleeping well at night and you're comfortable with the way that you structured something, that's your risk tolerance. Some people are okay to do super high leverage and kind of roll the dice and try to get a massive win and do so and scale it. Not me. And I'm not saying that's wrong to do it. You just have to structure deals of what makes the most sense for you. And we've chosen the business model of spending money, resources, and time on massive marketing to have tons and tons and tons of deals to look at in order to cherry pick the ones we're comfortable with. That's just the area that we've molded this model for better or worse.
Yeah, no, I love it. I mean, I always, top of mind to me, as long as investors' capital is in play, right? So I naturally, with my own money, I'm a risk taker. I always have been, and it has been a net positive for me in my life. But when I'm dealing with investor capital, I'm the exact opposite, right? I've got to protect this first and foremost. So I am a lot more conservative, and when it comes to that, and that's how we model it as well.
No doubt.
And that's important. So I just the folks that, and we'll wrap up on this, but that I worry about the most are the folks that have heard just a little bit about lending. They've got $500,000 sitting in a self-directed IRA, and they're like, I'm going to jump into this. They've never invested in real estate, but they've been told they can make 20% lending money. Their documents are screwed up. Everything is screwed up. They give 100% financing. They defer it to the back end. And those are the folks that are literally in nightmare financial situations because they didn't structure it right. And that's where, I mean, they have to get an education before they just say, oh, this guy's doing it, making 20%,
It's not even them saying this guy's doing it. It's more of they go talk to 5 people, and all 5 people says, all five real estate investors say, oh, this is how I'm structuring my deals with this guy. As long as you can match that, I'll do it. Right. Or you don't want to match that. Let that guy take the risk. Because that's what it's happening. They're going out and talking to 5 people, and they're saying, okay, based on the 5 people I talked to, they said they can put that, they'll do it with me at these terms if I don't have to make payments. Like, they're dictating the terms. What world does the lender or bank get the loan terms dictated to them by the borrower? Right. It doesn't work like that. You're the underwriter. You're the investor. It's coming out. You make the rules. You figure out what's work. And then their response is, and this is why this business is hard. Their response is, yeah, well, I talked to 5 people, and that means I can't do any of their deals. Like, how am I going to do any deals? In order to get into this business, I have to do it this way to get the deals.
Yeah.
Yeah. Well, there you go. That's why this is a hard business.
Jason, I cannot thank you enough. It's funny. I'll share this with you real quick as we close out. My partner, Bill, who you met in Charlotte, he made a joke. He said, because he's gotten to know you a little bit, he definitely knows me. He said, there is no way the 2 of you are going to get on a podcast and keep it under 40 minutes. I said, hey, let's go. But I mean, our brains work a lot alike. We get thoughts, we get down tangents, and I love it. But man, I think the value that you're bringing to the audience is unbelievable. Obviously, you've been doing it to your own audience for years. So I hope that folks will, follow your lead and check out what you have to offer. Again, if nothing else, check out the podcast. And I appreciate all you bringing. So
no, I certainly appreciate it. I appreciate you inviting me on. This was great. That was a lot of fun.
Yes, sir. Well, thanks for joining us, and we'll talk to you folks next time. That wraps up this episode of the Dealmaker Catalyst. If you want to keep learning from elite operators and plug into a national community that lives this stuff every day, check out Dealmaker Catalyst. Make sure you subscribe, leave a review, and share this episode with someone who's serious about leveling up. And we'll see you on the next Dealmaker Catalyst.